Rate cut prospects could bolster US stocks, but which ones and what are the risks? Welcome to Market Insight. I'm Ludovica Brignola. Hopes for a September rate cut remain firm today after Jerome Powell told Congress that the US is no longer an overheated economy, with those hopes bolstering the case for investors to remain bullish on US stocks. But could that bullishness be tested by upcoming corporate earnings and growing political uncertainty, just when the stocks rally itself is mostly concentrated in a small club of mega-cap tech stocks? Joining me now to talk about all that is Shana Sissel, Chief Executive Officer at Banrion Capital Management. Welcome. Hints of a slowdown in the labour market and a more benign inflation outlook, are they enough for Powell to conclude that the US economy is no longer overheated?
I think he is going to be data dependent, as he's continued to say. And I think they want to see the trend continue a little bit longer before making any decisions. They want to avoid a kind of a 1970s, 1980s occurrence where, they cut rates too soon and the economy got overheated. They don't want stagflation. And so I think it is most likely that September is when rate cuts will occur. I would be shocked to see any movement there this month.
Right, and in terms of that timing, what do you expect then after September as well? And for what concerns the size of cuts as well that you see coming?
So I think that the first cut will be fairly tepid. I don't think it will be a substantial cut unless between now and September something crazy happens and the economy completely nosedives. I think they're very focused on trying to have that miraculous soft landing that is so hard to achieve. It looks like that could actually happen. And I don't think they want to risk doing anything too extreme one way or the other that would send the economy either into faster growth, which could overheat, or into a nosedive and send us into a deep recession. So I think they're going to be fairly tepid for the first cut and see how things go from there.
That's really interesting. Let's turn to where the markets are going against that backdrop that you just described. I mean, many investors have cautioned that this year's rally is overly dependent on just a handful of big tech stocks, and some of your research as well points to a danger of a reversal. Can you tell us a bit more about that?
So you have seen high concentration in tech stocks. In the S&P 500 equal weighted versus market cap weighted, 10 stocks comprise 38% of the weighting of the S&P 500 and 31% of the net income as well. And they have driven most of the returns. Now, with that said, there's kind of large gaps here in the performance differential as well as in the valuation differential. So I think going into this next part of the market cycle where we start to see rate cuts, now would be a good time where you'll see differentiation of returns, which is very positive for active management. I think it will still be large cap driven. We've seen some abnormal technical data come out of the small caps, which isn't particularly encouraging, but I do think you'll start to see breadth improve, particularly in the large and mid cap areas of the market.
It's interesting that you say that's potentially very good for the active management side of things. But what does this mean for investors like you, for instance, as well, in terms of weightings in your portfolio, in terms of portfolio construction? And how do you guard against further risks ahead, especially on the political front?
Well, that is always a risk. I particularly right now feel like you need to include some defensive positioning in your portfolio. We've seen correlations between equities and fixed income rise. So some of the alternative areas of the market are interesting to me. Anything that has some sort of hedge aspect to it, market neutral. For example, there's an ETF that I follow, BTAL, which is market neutral, which is a very defensive position. And that is something we have an allocation to. MRSK, which is a hedged product, again, providing us some downside protection. Both of those things have low correlation to traditional equities and fixed income. And those are the kind of things I would want to allocate to in some way in my portfolio to sort of continue to add diversification and protect against the risks that come from equities and fixed income rising and correlation.
Finally, let's take a quick look at the earnings season that's just about to begin. Where do you see any shocks coming from, and are they positive or negative?
Well, I think the biggest risk here is that the technology stocks can't continue the kind of growth that they've experienced. They may still have good earnings, but the expectations are very, very high. So that's like the NVIDIAs of the world, the Microsofts of the world. That's not to say that they would not do well. It's just to say that they may not continue to grow at the same rapid rates. You know, NVIDIA in particular has grown earnings something like 2,000%. And I think it's unrealistic to believe that they would continue on that kind of momentum. They might have 100% growth, but that's not the same. And so I think the biggest risk is that earnings are not continuing to be as strong, but I don't think there's a risk to having earnings kind of come in much lower than expected. I think analysts in the street has been very conservative in their numbers, and that's actually why we've seen for, quite frankly, years now, corporations are beating earnings and surprising more frequently than they have in the past.
Shana Sissel, Chief Executive Officer at Banrion Capital Management, many thanks for sharing your thoughts today. And that is your Market Insight. You can watch more videos on Reuters.com.